Welcome to the Big Mike Fun Podcast, where you learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in. Because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fun Podcast. I'm the Big Mike Zlatnik. Today it is my pleasure and a privilege to welcome back Chris Miles. Hi, Chris.
Hey, Mike. How you doing, man?
I'm doing well. How about you?
Just excited to be here.
How's the world in Utah?
Not as crazy as it is in New York. I can guarantee you that. But it's crazy everywhere to some level, right?
Yeah, we live in very uncertain times. If I were to put any comment today, there's one certainty right now. It's the uncertainty. Things are very volatile, and we just don't know where we're going to go from here. Hopefully to a better place than where we are now.
Yeah, it's an upside down world. What was used to be bad is now good. What was good is now bad. The stock market's up in the middle of a recession. House, you can't even buy a house because everybody's competing for the same stuff. I mean, it's a crazy little world right now.
Yeah, who knew? We were all worried and concerned that the real estate prices would collapse, and they are in fact doing better post-COVID than pre-COVID.
Yeah.
The stock market, just a quick commentary, you can't go against Fed. Fed went completely ballistic on COVID. I mean, not just supported, they went ballistic. And what they did is they provided massive liquidity, low interest rates, and they created all this boost to the market. But let's talk a little bit about what you do. So you live in the mountain state of Utah, one of the best views, Salt Lake City, right?
Just south of Salt Lake City. Yep.
So love it. Been there. Greatest views. Probably the Rocky Mountains are the most beautiful in the States, right? It's a gorgeous place.
Oh, it is. Especially when you hit certain times of year. Just it's beautiful. It's gorgeous. This time it's hot and dry. So this is the time where I say, all right, come on, turn fall colors. Let's get some color in this place again. And then pretty soon the snow hits, and then you got snow-capped mountains, right?
Well, you have all four seasons and great skiing and great everything. So let's talk a little bit about. So you live in Utah. You got 8 kids.
Yep.
That's amazing. You are, I remember years ago, this is the joke, they got to give people a medal, right? I mean, if you have 2 kids, it's like an average. If you have 3 or 4, you're good. But once you start getting up there and you get to 8 kids, it's a lot of hard work. So you and your wife, you guys got to get a medal for bringing up so many, great new citizens to our future. So I'm giving you my medal for that part, as far as I'm concerned.
No, my wife definitely needs a medal for that, for sure. Because granted, we both share in the responsibilities of the family and everything, because I'm semi-retired and whatnot. But I'll tell you, I have 6 kids. She's got 2 from our previous marriages. Obviously, she going from 2 to 8 is a lot different than me going to 6 to 8, right? For me, it was just like, all right, just throw a couple more on the Barbie, right? But for her, it's like it was earth shattering. She's way more of a saint than I was for doing that.
That's a great point. I love you. You're in better position for sure.
For sure.
So she gets the medal.
Yep.
Now let's talk about business. So you do great work in infinite banking, and let's chat about it. We talked about it in the past, and it seems to be coming back. Just let's start with the basics. What is infinite banking?
Yeah, infinite banking is just a fancy term that people use to let your money flow in and out of life insurance, right? Specifically whole life, right? What most people don't realize, most people all know what term is, right? And it's death insurance. You pay into it, you die, you finally get paid. Actually, you don't. Your heirs get paid. You get nothing, right? You're dead. But with whole life, it actually is life insurance. It's got a cash value savings component, like a tax-free, much like a Roth IRA, right? Where you can actually, use it. But what most people do when they buy a whole life policy, they usually will buy it from an agent that will have it with heavy fees up front, which it normally does, right? So for example, say you're putting in $25,000 a year. After 2 years doing $25,000 a year, you're lucky to have maybe $1,000 in there in 2 years. So it's all going to costs, right? So this is why guys like Dave Ramsey hate it, They always hate on it and say, hey, this is horrible stuff. Not that Dave is like the best advisor for creating wealth, right? He's good for being broke, but not for wealth creation. But here's the key. Like the difference is like I do more of a max ROI policy where the death benefit's not so much the focus, it's that cash value. Because the thing is like a Roth IRA, you can only put in $6,000 a year or $7,000 a year if you're over the age of 50. But with life insurance, there's not those kind of caps. I mean, other than maybe 25% of your stated gross income that you can dump into these things. And it grows tax-free and it comes out tax-free, assuming you do it correctly. And so the nice thing is like we can actually let the money grow in here, make pretty competitive with market returns when you factor in that you can usually net, at least the way I design these policies, usually can net at least a 5% average per year return on this tax-free. You know, so if you factor into your tax bracket, that's like getting over a 7% rate of return in the stock market, which by the way, the stock market has only averaged 7.5% for the last 30 years before they take out all your management fees. So you're lucky in your little IRAs or 401ks to get 6.5%. You know, here we can actually do just at least that, but without all the market craziness, right? But that's if you let it go long term. From an investor standpoint, and that's more the standpoint I come from, I try to reduce those costs as much as we can, where we do a minimal death benefit with the maximum amount of cash going in, whatever that is. So I always reverse engineer. I always figure out like, hey, what's the max we want to put in per year? The minimum is going to be about 1/4 of that. So if your max you're putting in per year is, say it's that same 25,000, the minimum is actually only about 6,000. And what's cool is that first year, for example, you put in 25,000, instead of having zero in the first year, you'll actually have about pretty close to $20,000. The second year you do it again, you might have another 22, 23,000 going in. So now you're already at about 42, 43,000 instead of 1,000, right? All because of the way we can manipulate costs and do things. And what that does allows you to use that cash to go and invest. And now you can double dip on your money by getting your money working in two places at the same time. We can talk about that in a second.
That's absolutely brilliant. I understand this pretty well. And I have to say that that's the absolute honest truth. If you set up the policy with greater kind of cash ability to access cash in the early years, it helps if you're an active investor and you see a better opportunity. So it creates it's a self-funding mechanism. Whenever you need the money, in the meanwhile, it's growing at a 5%. Imagine that versus money sitting in the bank. So you put the money in the policy, it's growing at a 5% versus you keep the money in the bank, and I don't even know what they pay you. As soon as it's going to be negative rate. The rates are so low. We're going towards Japan model. You may be paying the bank to keep your money. So investing in a whole life policy like this, designed to give you access to liquidity and grow your money at 5%, is pretty good. Not only that, just a quick commentary from everything I heard, investing in a high quality life insurance company, some of these Penn, Mass Mutual, and a few other ones, it is extremely safe. It's like one of the safest parts of your portfolio. It's probably as good as FDIC guaranteed. Any thoughts on that?
Yeah, they have what's called reinsurance that every company is by law required to buy, right? So there's these reinsurance companies that insure an insurance company in case they go belly up, in case they go default, right? So, and that's pretty rare. I mean, if you look at the Great Depression, right, where we saw 50% of banks going out of business, only about 4 insurance companies actually went out of business during that time. Main reason is because insurance companies don't over leverage themselves like banks can. Like if we remember the last recession, we saw that happen so often where banks were failing because they had over leveraged themselves. They were loaning out more than they can create. And then when people are defaulting on loans, they were in a bad cash crunch. Insurance companies don't have that problem because they can't do that sort of thing. They just take this dollar for dollar, they invest their money or make it usually in low, like long-term bonds and things like that, treasuries and whatnot that they put in very low risk. And then they pay you dividends based on their company's profitability plus the returns of their investment, all that stuff. So yeah, I mean, even if they were to go out of business, the insurance company steps in, make sure everything's there, like better than FDIC. If all the banks failed, we only get 2 or 3% of our money back from FDIC. Here, this is fully funded. So even if they did happen to fail, which doesn't happen very often, there's still an insurance company to back it up, make sure that your stuff stays in place.
Yeah, it makes a lot of sense. We just did the deal, and you're familiar with the deal Riverbend.
Oh, yeah.
So that deal the primary mortgage funder, or the Voya life insurance company. I think the insurance companies, they actually need that first lien mortgage income. So they're happy
Yes.
to lend the money out fairly safely, and that generates the returns for them. What's most fascinating in this very low interest rate environment, the struggle for them is to pay you that 4.5%, 5% and lend the money out at a profit. So
That's
it's
right.
a challenging environment for insurance companies because their mandate is to invest the money safely.
Yes,
So
absolutely. And that's definitely if there's anybody that will come out with some sort of criticism, they'll say, well, hey, over time the dividends have been going down. Like some of the companies I use are usually between about 6% or so right now currently. Most are in the fives that they're paying. And people would say, well, yeah, they're going down because interest rates are going down. Well, that's true. Well, if there's hyperinflation, if they decide to drive rates back up, that also drives their rates back up too. So it can happen both ways.
although it is highly unlikely,
Mm-hmm.
if ever, the rate's going to go up. I mean, this is my opinion. I don't know what you think, but I think we're going straight to the Japan model. We're going to get
Uh-huh.
to very low into negative rates
Mm-hmm.
because look at what's happening right now. They're borrowing more and more money, and the debt to
Yeah.
GDP ratio is increasing. So what
Yeah.
happens when the debt to GDP ratio increases? There's only one thing to do: go to
Mm-hmm.
negative interest rates. Why? Because negative rates are better than default.
That's right. It's true, and that definitely can happen. I mean, well, I'll give you an example. I mean, my savings account, I'll even go with my money market. It was a little bit more drastic. My money market account in February was paying 0.45 in one of my accounts. When I looked at it again just last month, it was down to 0.1, right? Um, which
you,
is ridiculous, and that's taxable interest too, right? I'm getting taxed on that money, whatever little bit it is. My life insurance didn't change because it can only change once per year. Now, I did ask the companies, I said, hey, what would happen if we did move into more of this very low rate environment like we're kind of moving into? They said, if, one of the companies was at 6.1. They said, we might go from 6.1. They've been between 6.1 and 6.34 for the last 15 years. They said, we might go down to 5.6 if we stay long-term in this environment.
Well, that's what they're paying on the money that you invest into the life insurance policy.
That's correct. Yep.
Yeah, so the general expectation, I would agree with the trend that as rates are very low, life insurance companies can only pay lower returns, and if they go into negative, it'll be a little bit less.
Yeah.
So, but the primary benefit is not just the 4.5%, 5%, or even 5.5% return,
Mhm.
but it's access to the capital,
That's right.
and ability to take action with that cash. So you're basically
Mhm.
self-banking. You become a
Yeah.
bank that you can lend back to yourself without a fancy credit application and 2 years of tax returns and whatnot. You're the owner of the policy. You can literally borrow the money from the policy on one quick form, sign it, send it back in, and you get a check.
Yeah, and depending on which state you're in, there's also in most states there's 100% protection from lawsuits and creditors. I mean, other than the IRS, because IRS can get to any money, right? But if you have lawsuits or creditors in most states, this even if you have millions of dollars saved up here, they cannot touch it.
Life
It's very much
insurance.
like 401k protection, right? Where 401k is kind of similar guidelines there, But if you have money in savings, people can take it right out of your bank just like that. Home equity, they can take it, but here it's protected.
Great point. Because life insurance and IRAs are not you. It's the
Yeah.
trust for the benefit of I guess, beneficiaries, whoever, when you pass on. It's a
Mhm.
policy that, so makes a lot
Yeah.
of sense. That's great to hear. So how would people go about reaching out and working with you? Because this is great product.
Mhm.
Is there? We'll dive a little bit more into what else you do, but let's just talk about life insurance. This life insurance, infinite banking. What's the best way? How do they reach out?
Yeah, one thing I'd recommend is go on YouTube and look like a webinar that has me. If you look up Chris Miles Infinite Banking, there's a video on there. It says webinar, getting your investment money to pay you twice. Where I talk about how you can double dip on the returns, make money in two places at the same time. Watch that video first because it'll give you a lot of those details. It goes deeper. Then if you're like, hey, that sounds awesome, then just reach out to me, shoot me an email, or you can go to my website, moneyripples.com, and you can actually send me a message through there too.
So I was referring to the website. It's better to have a website with a link to the YouTube so people don't have to go find you. So
Yeah.
moneyripples.com is the way to go find Chris, rather
Yep.
than go YouTube and search for Chris Miles. That would be my 2 cents. But
Yeah, you might find a rapper, a little kid rapper that's named Chris Miles. That is not me, I promise.
it's the little you, the impersonator. But
That's right. Those copycats.
yeah, exactly. Now let's talk a little bit about financial planning. You also work with folks on the financial planning side.
Hmm.
Um, just let's start with the basics. What do you do? How do you help them? Because this infinite banking is part of the financial planning, right? It's
Yeah,
part of a
it is.
strategy.
It's just one little piece, right? Like it's not the whole thing. Right? Here's the thing I can promise you. There is no product offered by a financial advisor, including life insurance, that will make you financially free. Like it just the returns aren't there, right? With inflation that you're chasing, when you're trying to live off income, things like that, you can never really save enough in a mutual fund or an IRA. You can never save enough in your life insurance, at least not it would be an obscene amount of money if you're trying to retire short term, especially in the next 20 years, right? But if you combine it with things just like what you do, Mike, where you've got your own fund, right? You do these alternative investments. Like that is critical. And that's what I realized. I realized that in 2006. I was the mainstream financial advisor before I became the anti-financial advisor, right? As a mainstream up until 2006, I started to run those numbers and realized no one could retire, because the numbers, the market numbers weren't as big as they said they were. They were like 7.5% for the last 30 years as an actual yield on the S&P. Also, I realized that inflation was higher than I was stating. So when I put in real numbers into my little financial models, people weren't able to retire. It was really depressing conversations with people as a financial advisor, right? So either I lie or I just fluff the numbers a little bit to make them look better so they feel hope, but down the road they won't have hope. Or I stay in integrity. And so in 2006, I left the financial advising space, said I'll never do it again. I will just teach ballroom dancing and I'll do mortgages as a mortgage broker. But definitely people kept, I was able to retire in 2006. I was able to do like real estate investing and things like that got me to retire. People are like, well, how'd you do it? So I came out of retirement in 2007 to teach that. And so that's why I'm the anti, because I'm against mutual funds, like from the standpoint of trying to retire off of them and that sort of thing. If you want to have some in your portfolio, fine, but don't bank on them, right? You really do need help. And that's where finding someone who could say, hey, let's look at your whole picture here. Where do we find money? And how can we turn that away to be able to help you make more, right? Give you an example. I know that we were just talking about somebody before we were talking here that we share as a clientele. Like they're investing in your fund. They're also a client of mine. They're dentists. And what was fascinating is looking at their situation. I was like, well, yeah, you've got all the components here. We can get you retired in the next year or two. We can move this or that, or what should we do with these IRAs, or should we go here or there? I'll never tell people to just invest, right? Like I'll never say you should invest here because that's crossing the line. I don't do that. But I will say, hey, if you invest in this place, or if your goal is cash flow, here's the type of things you can invest in. These are the ones that will give you these kind of results. If you're going for growth, here are some great things you can do as well, and fits in that model. And then we just discuss and figure out what's the right fit for them based on what they feel is good. But what's amazing is that with them, I was like, we can get you guys retired in the next couple of years. He's already ready to sell his practice. He said, Chris, I would sell it today. Yeah, especially after COVID, I would sell it today for a 10% discount if somebody would buy it. I would do it right now. I'm like, good. Well, we can plan around that too and make it work to where you could retire comfortably and be fine. Oh, and by the way, they actually had me look at their infinite banking policies. In the next 20 years, we actually replaced it from what they were doing with another infinite banker, quote unquote. It's going to make them over $2 million more of cash in the next 20 years, doing the same thing dollar for dollar, just doing it more efficiently.
Yeah, it's fascinating. I could tell you that I have one of these policies and it wasn't designed the right way. And it's unfortunately was good for the
the agent.
For the agent in the
they
commission
made good
side.
Money.
Yeah, they offered the most commissioned product. It was a good product, but it was just best commission for them.
Yes.
So, and the most interesting, what you just said is many people have enough assets today. They just don't realize and actually retire. It's almost like revelation. Let's go through your stuff. Or what do you got? Whole bunch of stuff that's not sitting in the right place. And if you put it in a better investment vehicle, you can suddenly feel a lot more comfortable and confident that you can live off, basically retire, be a passive investor at that point.
That's
So
right.
it's a great feeling, and I'm sure it's a great satisfaction for you to be able to work with people and look at their stuff and say, wait a minute, you don't think you can retire, but you can. Here's the roadmap. So
You know,
makes a
you
lot of.
Yeah, talking about planning, it's funny to see the difference between how you and I think versus what the traditional model thinks like, right? Because the traditional model is save up those assets, be big, and then try to live off less than the interest so you don't run out of money.
Or earn the 2%
Yeah,
returns, the dividends on S&P 500. Wonderful. That's great.
yeah, yeah.
Yeah,
Because
sure. It certainly can keep your wealth, but it doesn't give you enough income. That's one of the problems with the stock markets. One
yes,
of the major problems, the P's being so high that the incomes and the distributions of dividends are just out of control. So what's happening out there, in many ways, in my opinion, unfortunately, the market doesn't listen to me. It's overvalued, but relative
yes,
to what? Relative to these very expanded P's. The reality is very
yeah,
low interest rates. There are no alternative of bonds.
mhm,
Companies can use this very low interest rate environment to have these massive PE expansions, and that's what's happened. So
yeah,
we're dealing in this environment where people are willing to pay these very high prices for very low incomes in the
mhm,
stock market, and pretty much the play is appreciation. If somehow that thing breaks, it's going to be bad. It's going to be,
yeah,
no certainty. Asset prices could collapse. Who knows what's going to happen? So the
yeah.
predictability of that is very low.
That's right. Yeah, I remember almost 20 years ago when I first became a financial advisor. Like, I remember my goal was to save up $2 million by the time I was 40, and then live on 4% a year. Which back then I thought 4% a year, that'd be 80,000 a year. That's amazing, right? I thought that was the biggest lifestyle ever, was $80,000 when I was 24, 25 years old. So 80,000 sounded like an obscene amount of money. Today it sounds like you're barely surviving, right? So
Yeah,
inflation's
inflation.
big.
Yeah.
Yeah. But I'll tell you, like, the other thing is too, like we mentioned, interest rates dropping. We're seeing this with everything else. When people try to go in their retirement plans to be more conservative, right? They used to say 4% a year, but that was based on a model from the 1970s. That doesn't work anymore. If you want to, and we're living longer than we did in the 1970s. So if you want to make sure you don't outlive your money, and with the lower returns, you probably, like you were saying, do more like a 2% rule. Which, think about it, if you had $2 million living on 2%, that's 40,000 a year. You're about the poverty line. As a multimillionaire, you're at the poverty line. But $2 million, like, I know, even with funds like yours and things like that, someone could turn that into to at least six figures a year minimum. You know, very different lifestyle, and that's what blew my mind in 2006 when I saw, wait a minute, it's not about trying to live off less than the interest, like trying to let it stretch out, because that's what financial companies want you to do. They want you to leave your money in there so they can have more assets under management and make more commissions. But when you do things with alternative investing, especially if there's cash flow from it, now if you make an 8% or 10% return, that's a massive difference. That's the difference between having 40,000 a year versus 160 or 200,000 a year from that same $2 million. It was mind-boggling for me. It blew up in my whole world, and that's why I could never go back. My brain got stretched too much.
That's right. So what's possible in real estate, especially now, what's got really, really attractive, real estate does work on leverage. It's the
Yep.
most financed asset class out there, tax
Yeah.
advantage. And a lot of projects take advantage of very low interest rates, and then they borrow and they create leverage. Now, leverage has risks, obviously, but if it's a good, healthy leverage into productive assets, it's a hedge against inflation, number one. Number two, can generate substantial income and substantial growth. So predictability is
Right.
much higher, and it's a very different investment from your traditional Wall Street. And you have to realize that the Wall Street made it extremely easy. That's been their
It's the fast
selling
food of
point.
money.
Fast food of money. You get your
It,
junk,
it, it has
and
no health. You'll die early from it. It has no real benefit, but it's out there for your convenience.
they're great marketers. The Wall Street bunch of brilliant marketers, and that's what they've sold to the masses. So
That's right.
going back to infinite banking.
Hmm.
So do you have any kind of brilliant, like just like give people a hint or a great idea or some really advanced technique. Because the basics they know, they need to work with you, but you have some really cool thing with infinite banking. One of these interesting, obviously you could use it as your own retirement. We
Sure.
actually set up for my wife whole life policy as a retirement. So the objective is to use it instead of put your money into 401k, or not a 401k, but IRA,
Yeah.
SCP IRA. Put
And
it
there's
in.
no age restriction either, like you have with IRAs and 401ks, which is nice.
Yeah, so this is what we discovered. It's better than, it's tax advantage. It works better than, you know, just contributing to an IRA. You're not dealing with the limits and so. Any other interesting thoughts?
Yeah, so I'll give you an example. A guy I just talked to today, he was looking at it because he had seen a YouTube video I was on and stuff, and he's like, you know, I've heard about this, but it seems unique. Anyways, I mean, in his situation, he was thinking about trying to retire early, which, like you said, you know, Roth IRAs and other IRAs are pretty tough because you still have that 59.5 rule you have to deal with, right? Well, he's like, well, that sounds cool, but you mentioned you can do stuff with real estate investing. Like you could actually make money in two places in the same time. How does that work? Well, I told him, I said, well, here's the deal. Like you can put money in, right? You can, and the cool thing is, unlike a Roth where you're only limited to 6,000 or 7,000 a year, you could put in a lot more. So in his example, he's like, well, show me what 60,000 a year would do. Because the max he could put in is 60,000. He's 43 years old. The minimum on that's like just under 15,000. So about a quarter, right? Well, so he's got some flexibility. He doesn't have to put in that much per year, but he wants to put in 60,000 a year for the next 8 years before he retires. Well, the cool thing is he wants to buy real estate with this. And I said, that's perfect, because if it's, you know, either growth oriented, it could be short-term investment, or if it's cash flow oriented or even dividend oriented, whether you're getting paid quarterly dividends or whatever it might be. The cool thing is you can take that money, borrow from the insurance company, right? So the insurance company gives you like this line of credit. That's almost like getting a home equity line of credit, but instead of only paying interest, you get paid interest. Because the cool thing is if you have the money in here growing tax-free, you borrow from the insurance company, all the money's still here. You could take a withdrawal from an insurance, by the way. You can withdraw it just like a savings account. It takes about a week to get the money, by the way. You could take that out, but if you withdraw the money, you lose the ability to earn interest on that money. But if you leave it all in there and you just take a line of credit against from the insurance company.
Effectively loan.
Yeah, it's just like a loan. The cool thing is the loan has no minimum monthly payment. It's not on your credit report. It's perfectly just a private loan that you're getting from the insurance company. But they will charge interest like 5% a year, for example, right? However, if you use that money in something that does cash flow, and it can be used to pay off debt, sure, but it can be used especially for asset building. Because if you can go buy a property with this, you borrow the money, a week later you got the money in your checking account, you go and use it to buy an investment. Then as the cash flow is coming in, you use that cash flow to pay back on that line of credit. Because you can pay it back however, whenever you want. The loan is only due in full when you die. So death is your deadline. And they just take that out of the death benefit anyways. But
no, it's incredible. What you described is you have money in the bank. You could keep it and get your 0.1% or whatever, some tiny interest. You take that money, you put into whole life, infinite banking policy, so that, and you're flexible, you could put more or less. And you have an investment opportunity, you pull it out, as you mentioned.
Yeah.
The investment is producing income. And now if you had the cash in the bank again, it would sit there and earn nothing. Instead, you take that cash and you pay back to the life insurance company. The money is working at a life insurance company at that 5% rate. And you're not, it's almost like you can always keep the money working at a 5% rate at minimum while the banks pay you absolutely nothing or a fraction of a percentage.
And this is the key distinction. This is the part that I didn't understand till about 10 years ago, and it blew my mind, was there's two different types of interest. There's simple interest and there's compound interest, right? Understand that. So when somebody says, well, hey, if say I'm netting 5% on my policy, even though they might pay you more, right? But let's just say it's 5%, but I'm paying 5%, I'm not earning anything. It's just a wash, right? You'd think, because 5 minus 5 is 0. Well, interest doesn't work that way. Because understand that when it's in your policy, it's compounding tax-free. When you're using that loan, remember that money you're taking back from the income that's coming in, you're using it to pay down the loan. So what happens is that the interest you're paying goes down, down, down. Just like when you have a loan, like a car loan, every payment you make, more and more goes towards principal than interest. Not because the interest rate changed, because the interest rate's the same. It's because you paid the balance down.
Yeah, compounding.
So yeah, so it's a simple interest as it's paying down. So it's almost like if you look at a chart, interest goes down like this on the simple interest, the loan side, but the compound interest is going up like this.
On the growth of the cash value of the portfolio.
Yeah, exactly. On the growth of that savings inside the life insurance. So what happens is that you're actually making a net. If you look over time, like I ran a scenario for somebody who bought a turnkey property, and the net ended up being, after 9 years of doing that and paying down the loan with the cash flow and everything, the net ended up being about a 6% rate of return on top of the return they're making on their property, right? So if you're earning, let's say, a 12% cash on cash return on your property, add another 5-6% on top of that, and that's what you're earning because of the life insurance. So the life insurance is actually allowing you to make money in two places at the same time. Interest inside the insurance policy is compounding. At the same time, you're making money on your investments over here. It's almost like throwing on, even with somebody that's 50 years old, it's still throwing an extra 3-4% on top of whatever return you're making on your investment. So it becomes a no-brainer.
Yeah, and it's absolutely brilliant. The other interesting, just a quick thought, some people are worried about legacy, and life insurance policy have been used by Rockefellers and many of the super wealthy to create generational wealth. And
Yeah,
it's a way to pass value or assets or capital to your heirs tax-free.
that's
So
right.
the code is written. Again, I don't know what's going to happen forward. Maybe they'll write some crazy code. They're going to tax this stuff. Who knows, right?
Mm-hmm.
There's a whole. I mean, if you hear what's going on right now in California, they're proposing to start taxing wealth, but we'll see what happens. Life insurance is going to be outside of all that, right? If you have a life insurance
Right.
policy and they're trying to tax you, it's not your wealth. It's basically the benefits of your heirs. It's kind of
Yeah.
interesting. You're going to tax little kids that are, who knows?
That poor orphan Annie, right?
Yeah,
Yeah.
but we're living in a world where the taxes are only going up.
Mm-hmm.
Unfortunately, it feels like the budget problems, the deficits, and and the inability of the government to manage the budgets. They're going to need
Yeah.
to have higher taxes to manage. And it is something that we have to worry about. And life insurance is a mechanism that creates legal tax shield. It's like you could do tax avoidance or tax evasion, right? So
Right.
tax evasion is illegal. Tax avoidance is perfectly legal.
That's
Life
right.
insurance is tax avoidance.
Yep, it totally is. And you kind of remind me of something too when you talk about the Rockefellers, not just about the death benefit and the legacy, which is a huge cool thing, but even if you've ever been to Walt Disney World, right? If you've been to Disney World, you are seeing evidence of life insurance, like the benefit of life insurance, because Walt Disney could not get financiers for buying or that whole property in Orlando. He wanted to build out Disney World, but they said, no, it seems too risky of investment. You need to put up more of your own cash. Well, where did Walt go to get his cash? His life insurance. He actually leveraged his life insurance policy as the cash down payment. The banks then came in with the rest, right? And they were able to leverage it there. They understand that life insurance, whole life especially, was as a tool used especially before the 70s. The 70s is when all the financial advisors started coming out and marketing like crazy, buying mutual funds and stocks. People thought stocks were more of a gamble, and they still are. But now it's become more mainstream, where back then that was the mainstream. People were using that, just like Disney.
Yeah, there is misconception. It's interesting. When I started my career in technology, and we were all trained into 401ks, the all option we had available a bunch of funds, and I always noticed there were heavy in fees funds. All these 401k plans just had the fund fees, the
Mm-hmm.
custodian fees, the administrator fees, and all this stuff just felt very heavy. And
Yeah.
then years ago, when I was chatting about life insurance before I went invested into life insurance, some of the financial advisors who were selling stocks, the whole song was, no, don't do that. Those things are so heavy in fees. You're
Uh-huh.
going to pay some life insurance agent obscene amount of money. In reality, it's the reverse is true. I
Mm-hmm.
mean, everybody sings the song that works for them, and
Yeah.
they were singing the song that was working for them. So
And
it's
there's partial truth to that, because I mean, That's the cool thing. Like I'm kind of at the point where I don't need to make the money, but that's why more people are using me to do life insurance than ever. It's the ironic thing is like when you're out of the rat race, that's when everybody wants to pay and do things with you. But I'll tell you, like, it's true. I mean, there are hefty fees. Like a normal whole life policy, if you pay into it for 15 to 17 years, you'll finally break even, right? So if you put in 10,000 a year for 17 years, you'll finally have 170,000 at that point, and then it'll start to exceed. The difference though is when you find creative ways to cut back on those insurance costs and fees and allow more money to get stuffed in there with less cost, which is what I do.
That's
right?
the main benefit. Yeah.
Yeah. Then instead of taking 15 to 17 years to break even, you do it in 5. You do it in 5 years, and then from there it's just exponential. So with my kind of policies when I'm writing them, only the first 2 years or so has actual net cost. But from about year 3 or 4 on, there's always a net gain. So it's almost like what I call a supercharged tax-free savings account, right? Where it's just growing tax-free. It's allowing money to go in. So somebody's like, well, what if I can't pay, like that guy? He's like, what if I can't pay 60,000? Well, I said, well, you're not even required to pay it because you can pay less. But even if you did, especially if it's like the 3rd year, say you borrowed from the cash to then put it right back in, it's just borrowing from it to go right back in again, I had a guy who was a doctor said, hey, I want to put in 100,000 a year for 3 years and then stop. And I said, well, we could do that. We just have to have you borrow from it the month before it's due to put it back in. And he did. And even after the 7th year, when he could stop paying altogether, he still had over 250,000 in cash, even though he only put 300,000 in, and he was just putting the money in and let it pay for itself, and then it grew tax-free from that point on anyways. So there's all kinds of creative things you can do with it.
Yeah, I like the supercharged tax savings account. When the rates were higher, this didn't look, at least you can get some return in the bank, but now you can get any yield. So
yeah,
stuffing cash into policy beats the heck out of keeping cash in the bank. I mean, that's a real simple, if people can't come up with any other benefits, that's one simple one. So back to, we're out of time, moneyripples.com. Appreciate you very much. Thank you again. Any final thoughts? We got to do it again. This was, unfortunately, we can't have these episodes to run too long, so we're trying to keep them a little bit short.
Yeah, the same thing on my podcast as well. They're like 20-minute episodes, and that's it. So I would just say final advice is this: is that if we were to sum all this together, is that there's hope. Like there's way more hope and possibility of what you think you can create with the money and the resources you have. That's the biggest shocker for people. When I talk to them, they realize, wait a minute, are you saying I can generate another, several thousand a month passive income? And the answer is yes, if it's not locked up. And right now is your golden opportunity. Real estate market's at all-time high while interest rates are an all-time low. It's the best time to get cash out of your home. It's the best time to get cash out of the market. Not saying that you should take your money out of the market as a disclaimer, but market's all-time highs, real estate's all-time highs. There's cash. You've got equity. This might be the time to actually put it to use so it works for you finally for the first time in your life.
That's a great advice. It feels like we have real inflation, and there needs to be a way to mitigate. Real estate is one of them. I mean, whole life is a very interesting tool to take advantage of all kinds of benefits. And at the end of the day, I don't want to argue with economists, but I believe that the reported inflation, the CPI, unfortunately, underreports the real street inflation.
Absolutely.
And that's the reality. You can't believe what the government tells you. Unfortunately, I wish we had. Just final comments. So I grew up in the former Soviet Union, and I'm a political refugee. I got away from them. I got to America, and it's a great country. It's been many years. I'm a U.S. citizen. I've been here for much longer than I was there. Over there was one source of information. It was all propaganda. Single party was always pushing what you're supposed to know, believe. You come over here, and then you're realizing now you got 2 major parties, and they're pushing completely opposite stories. So now it's difficult to believe information here either, because you've got 2 versions of the history, 2 versions of the truth.
Exactly.
It comes down to you as an individual need to make your own opinion and build your own thoughts. And unfortunately, the government data and the government presentation of the truth can be manipulated and not necessarily the real truth. So I'm not creating these grand conspiracy theories. I'm just saying be smart in your own way. So
Amen to that.
I appreciate you, Chris. Thank you kindly, and we are done. Thank you very much.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike Zlotnick. Keep listening and keep investing Big Mike style. See you on the next episode.